Hey, what's up? Welcome back to Chalk Talks with Coach B. Every month on Options Expiration Friday, the market does something that looks almost rigged. A stock will drift toward one specific price and practically pin to it right at the close. Traders have a name for that price. They call it max pain. Today, I'm going to show you what it actually is, why it happens, and just as important, what it is not. So what is max pain? It is the single strike price where if the stock landed there at expiration, the largest dollar amount of calls and puts would expire worthless. Said another way, it is the price that hands the most pain to option buyers and the smallest payout to option sellers. You find it by adding up at every strike what the in-the-money options would be worth and then finding the low point. That low point is max pain. Let me show you a real one. Here's AMD's open interest going into the July expiration. Every strike, calls in blue, puts in red. The stock is sitting around $552, but run the math across the whole chain, and the max pain strike is way down here at $510. That is the price where the most contracts expire worthless. So there is a kind of gravity, a magnet tugging from 552 down toward 510 as expiration gets closer. Now, here's the part most people get backwards. This is not a conspiracy. Nobody is in a back room steering the stock to take your money. What is really happening is delta hedging. The market makers who sold all those options have to stay neutral, so they are constantly buying and selling shares to balance their books. As expiration approaches, all that hedging tends to nudge the price toward the strikes with the most open interest. It is mechanical. It is a side effect of the plumbing, not a plot. And this effect is documented. Researchers who studied expiration days found that optionable stocks really do tend to close a little nearer to those heavy strikes. So it is real. But here's the big but. It is a tendency, not a rule. This is where the hype gets people. Max pain only matters in liquid, heavily traded names, and only as you get close to expiration. Weeks out, it is basically noise, and it breaks the instant real news shows up. A strong earnings report, a Fed surprise, a hot sector, any real catalyst sends the stock right past max pain like the magnet was never there. Plenty of expirations, price never lands on it at all. So how do you actually use it? Not as a buy or sell signal. Use it as a lens, a way to understand why a quiet stock gets sticky around certain prices on expiration Friday. It explains the pin. It does not predict the future. Quick reminder, this is education, not financial advice. I'm showing you the mechanics so you can think for yourself. So 3 things to lock in. 1, max pain is gravity, not a guarantee. 2, it is strongest in liquid names right at expiration. 3, it is a lens, not a signal. Get those right, and expiration week will start to make a whole lot more sense. Good luck in the markets, no matter what stock you're into.